Hello, on this teaching this morning we are going to be looking at Forex and how it works. The Forex market, we said the foreign exchange, which is also called the FX, the market in which a currency is traded. Forex market is the largest and the most liquid market in the world, with an average trading volume of about $7.5 trillion per day, and include all the currencies, most currencies of the world. Trading in Forex trading, we exchange one currency for another. For example, we have you trade you trade the US dollar, you trade the EUR, which is the euro, for the USD, and the GDP for the USD. You buy the euro and sell the USD. You buy the GDP and sell the USD. So the currencies are always exchanged for one another. One is the first one is called the base, while the second one is called the quoted currency. The quote. There is, in the Forex market, there is no central marketplace where currency is being exchanged. It is done in what is called the over-the-counter. The Forex market is open 24 hours a day, 5 days a week. Currencies are traded worldwide among major financial centers of London, New York, Tokyo, Zurich, Frankfurt, Hong Kong, Singapore, Paris, and Sweden. The Forex is the largest market in the world in terms of the total cash value traded. And any person, firm, or organization, institutions, or countries can participate in the market. What are the major currencies be traded in the market? We have the US dollar, we have the euro, we have the Great British pound, we have the Canadian dollar, we have the Australian dollar, we have the New Zealand dollar, the Japanese yen, and the Swiss francs. And these are their nickname. For US dollar is called the greenback, while the Europe also called the Europe, the GDP, the Great British pound, which is called the cable, which is GDP, and the Canadian dollar, which is called the loonie, CAD, the Australian dollar, Aussie, AUD, and the New Zealand dollar, Kiwi, which is NZD, and the Japanese yen, which is JPY, and the Swiss francs, which is called the Swiss CHF. When we talk about currency pair, we are talking about pairing one currency with another currency, a currency of one country to the currency of another country. For example, if you are traveling from your country to another country, when you get to the international airport, you will need to make an exchange of a currency, because you are not going to spend the currency of your country in the other country. You need to, when you get to the other country you are going to spend their currency. So when before in your traveling, for example, in the international airport, and you change currency, what you are actually doing, you have just done Forex. So you buy and sell the base currency at the expense of the counter currency. You buy, for example, the Euro USD, you buy the Euro and sell proportionally the US dollar. Also, and when we talk about when you buy, it's also called, we say you have long the Europe, and when you sell, we say you have short the dollars. You sell, if you sell the Europe, you on the other side you buy the dollar, and it's also called, when you sell, it's also called, like I said, shorting the euro and longing the US dollar. Currency, major currency, currencies and their symbol. We have what we call the major currency, we have what we call the minor currency, or the cross currency. We have what we call the exotic currency. Major currency are the US dollar, the Euro, the Japanese yen, the Great British pound, the Swiss francs, the Canadian dollar, the Australian dollar, and the New Zealand. While the minor currency are for example, the Swedish Koran, the Norwegian Koran, we have the Danish Koran, we have the Polish Lottie, we have the Mexican peso, we have the Singapore dollar, and the Hong Kong dollar. We have in the exotic currency. These are currencies that are very volatile. They are very exotic currency, not highly traded because they are very volatile. They are more volatile than most of these major currencies. We have the South African rand, the Russian ruble, and the Chinese currency, and so on and so forth. Currency pairs. When we talk about major currency, we are talking about, when we say the major currency pairs, we are talking about, anytime you hear the word major currency pair, we are talking about a currency that carries the US dollar in one side of the pair. For example, the Euro USD, the GBP USD, the USD card, or the Australian dollar and the US dollar, the New Zealand dollar and the US dollar, the US dollar and the JPY, Japanese yen, the US dollar and the Swiss francs. These are major currency pair. While the cross currency, on the other side, are currency that does not have the US dollar on one of the side of the pairs. Because the US dollar is the trading currency of the world, so most currency are paired with the US dollar. So, but the cross currency pair, for example, and the Europe GDP, the Euro JPY, the Euro AUD, the Euro New Zealand dollar, the Euro card. We have the Great British crosses are, for example, the GDP JPY, GDP CHF, GDP card, GDP AUD, and GDP NZD. We have the card crosses, which is the Canadian dollar crosses. We have the card JPY, the card AUD card, and AUD NZD. We have the AUD crosses, we have the NZD crosses, and these are currency that does not have US dollar in any of their pairs. We also have some major terminologies in Forex. There are many, but we are just going to look at these four, and in our subsequent teaching, we are going to be looking at major terminology in the Forex market. Just as in other field of life have major terms that are used and vocabularies, the Forex market also has its own vocabulary. For example, we have what is a pair. We just said a pair is a combination of two currency that contains both the quote, the base, and the counter currency in its name. Sometimes it is also called the instrument or the market. A pip is the smallest units of measurement or the smallest number to represent the change in the value of exchange rate of a pair. When you are trading a currency, especially if you are in the trading terminal, maybe either MetaTrader 4, MetaTrader 5, or TradingView, and so many other trading platforms, you will see the quotes being on it, and the pip side, you see the pip, the price is moving, and like we said, the pip is that small changes that the changes that you see in the price movement. If for example, if you have a quoted price at maybe 1.10004 and something like that, and it changes from 0.04 to 0.05, that change, that just little change from 4 to 5, that one difference is also regarded as a pip. Normally, a pip is a 4 decimal point of a quoted price, except for the Japanese, which is always the second decimal point. What is a spread? A spread is the difference between the buying price and the selling price. The buying price and selling price in a currency pair similar to that of a bees and the axe in the stock market. We have what they call the lot size, the number of currency per unit being traded is a lot. For example, if you are buying a bunch of something, there are certain things you cannot just buy as single entity. In a single entity, you have to buy them in bulk. So also in the forex market, you want to buy a currency, you are not allowed to just buy one. You buy them in bulk. So they are categorized into majorly four. We have what we call the standard lot, we have what we call the mini lot, we have what we call the micro lot, and the nano lot. The standard lot is 100,000 unit contract, while the mini lot is 10,000 unit, while the micro lot is 1,000 unit, and the nano lot is 100. If this teaching has given you value, I need you to subscribe to my YouTube channel so that when I release new video, you will always be the first to have it. I need you to click the bell and the notification button so that you can always have my video. Thanks.